So before we move forward, let's try to understand the end outcome of principal component analysis. It will be a set of 30 equations called singular vectors or also principal components. And not all of these 30 are important. Some of them will be very dominant ones, and we have to identify which of these 30 are the dominant ones, and we'll ignore the rest of them. Now, once we have identified the dominant equations, if you notice, this is just a linear combination of all the stocks. So there are some stock prices multiplied by some coefficients. So let's say, for example, if PC1 or the principal component 1 turns out to be the most dominant equation, then in this we have to see which stocks are getting multiplied by the largest coefficient. And that stock has very big influence on this principal component. So that's the end aim of this whole PCA. So let's get started. I have loaded some Python libraries here. And here I have picked up all the ticker symbols, 30 of them till here. And lastly, there's a Bombay Stock Exchange Sensex symbol. And I'm going to run through all these symbols to download the data. My start date is 1st April 2023. My end date is 17th July 2024. And I have initialized an empty data frame to save all this data. So in this for loop, I'm just going through each of these tickers and picking up the data, that is the close price, end of the day data from Yahoo Finance website. And then I'm going to save it as a data frame and do further analysis on the data. And I do a little bit of cleaning. Wherever I find blank fields or missing data, I drop those rows here. And lastly, I just pop out, as I told you that Sensex is also part of this data frame. I just pop out that data in a separate data frame called Sensex for plotting, etc. So let's see the shape of this data. Let me just run this code. So as you can see, the shape of the data is 298, 30. That is 30 companies, 30 stocks, and 298 days of data. And let's have a look at this data. So let's have a look at the first 5 entries. And as you can see, on the columns we have the companies, the stocks, and the rows are having prices, daily prices, starting from 3rd of April, because I think 1st and 2nd was Sunday and Saturday. So this is the first 5 entries from the top, and we can also actually have a look at the bottom of the data frame. So again, we are going up to 16th of July 2024, and all these are stock prices. And remember, all these stock prices for each company, there's a difference in the price. For example, Mahindra & Mahindra, this thing is having a price of 2,732, whereas any other company, if you see, for example, let's say Tata Steel, its stock price is hovering around 166. So since there's a disparity in data, in prices, we have to do something, and I'll talk about it in a bit. Before we move further, let's just see if we have captured the Sensex correctly. So for that, I'm going to plot. If you remember, I had saved this data in Sensex variable, and I'm going to just plot this now. Oh, just a minute. This should be commented out, and let me run the code once. Yeah. So here is my Sensex for the period that I indicated from 1st of April 2023 to 17th of July. And as you can see that it has crossed 80,000 currently. And the data is more or less correct, Sensex data. And I'm also going to plot the stock data that I've downloaded, and it'll reveal a problem. This is the stock data. So these are color-coded lines are stock prices of 30 companies. And as I highlighted earlier, you can see that certain companies are, the stock price are hovering between 100 to somewhere around 3,000, 3,500. And some companies are having very high stock prices. And we have to normalize this data set, otherwise the statistical analysis will not be correct. And that process in statistics is called normalization of data, because there's a vast variation in the prices of the stock. So what I'm going to do is that I'm going to take each one of these stock prices. I'm going to compute the average stock price and the standard deviation, and I'm going to subtract the average price from all the daily prices that I've accumulated, and I'll divide it by the standard deviation. This is a standard practice which is called as a normalization of data, and I'll do it for all the stocks. And this is what exactly I'm doing is I'm subtracting the average and dividing by the standard deviation. This transforms the entire data set to 0 mean and variance 1. And then I'm going to plot both the data and the scaled Sensex. Remember, the Sensex is also having very large numbers like 80,000 and so on and so forth. So that also needs to be taken care of. Hence, both these things are scaled. And let's have a look at the data now. So first we have a look at the shape. The shape remains the same. We have 30 stocks and 298 days of data. And again, we can have a look at the top 5 rows of the data. And you see that now these prices have dropped to some very low numbers, and these all numbers have become comparable, and that's exactly what normalization does. We can also have a look at the last 5 rows. That is, so this is these are last rows, and you can see these are now become very small numbers, and now they can be compared. They're on the equal footing, they're on an equal benchmark, and they can be compared orange to orange. So that's it. I will also show you what happened to the Sensex data after scaling. So this is, earlier my Sensex was going up to a very large number, that is 80,000 plus. Now it has been scaled down to something between -2 and 2, and now it is comparable with the rest of the stock market data. And lastly, I'm going to plot all the scaled down stocks. And as you can see, so these stocks have now become comparable with each other. These are the 30 companies, 30 assets, and these are the stock prices. And now these numbers are varying between 3 and -3. So Sensex is varying between 2 and -2, and the stock prices are varying between 3 and -3. This is exactly what the normalization process is. Moving forward, I would like to now do a quick correlation check between the stocks. Remember, I have to understand the underlying patterns of what's going on. So I just ran this. Essentially, I've just taken this scale data, and I've run a correlation matrix on top of it and generated a heat map. And if there are positive correlations, it will be indicated by red color. If there are negative correlations, that will be indicated by bluish color. And as you can see here, most of this matrix is red in color. You can see, I'm not sure if you're able to see it. Here, we start off from the automobile sector, then we go to banking sector, here, then cement, then refinery, construction and engineering, financial services, FMCG, and so on and so forth, power, etc. So these are 30 companies, and as you can see, most of this matrix is looking red. That means a lot of stocks are correlated. Very few of them are not correlated, which are shown in blue color. And there are some sector-specific correlations. For example, these 3 companies here are from automobile, and again, these 3 companies are automobile, and they are having some very strong correlation. Similarly, if we talk about the banking sector, they again have very strong correlation, except for this Kotak bank and all. So this can give you a very quick idea as to what is happening in your data set. And let's move forward. So idea here is now that I've generated my A matrix, as I mentioned in the PowerPoint, and now this A matrix is required to be decomposed into 3 parts, that is mu, sigma, and V transpose. And I have 2 approaches to do this. One is from the first principles, as I shown on the PowerPoint. And then I will also compare it with a built-in library called scikit-learn. It has a pre-built function called principal component analysis. I will do exactly the same analysis using that piece of code, just to be sure that we are on the right track. Starting from the first principles, if you remember, I have taken this scaled data, and now I am doing the singular value decomposition on this data, which will generate these 3 matrices. And then I'm going to, firstly, let's see what's the shape of this data. So we have shape of U, shape of sigma, and shape of VT, and these are the shapes as I mentioned earlier. This should have been 298 by 30, but I have used a shape enforcement on it, which is this one. So that's the result. It's not what that was shown in the slide. So shapes are available to us now. This matrix is required to be converted into a diagonal matrix, because that's the way Python works. Python has just outputted array, and that array needs to be converted into a diagonal matrix, because sigma is a diagonal matrix. So this piece of code is doing that. And once I've done that, I will prove it to you that once I multiply these 3 matrices back, I will go back to my stock data, which is my original scaled data, stock data. And I will prove it to you that this decomposition is working fine. So reconstructed data will be matrix multiplication between U, the sigma matrix, that is the diagonal matrix, and the VT. And then I'll plot all of them together. So this is my plotting code. And let me just run this. So when I run this, here I am. So we are now, if you can see, this is my original scaled stock market data, 298 days here trading, and 30 companies. And the color code here is signifying the price of various assets, the closing prices. So this was my original data, and I have decomposed it into three parts, into three different matrices. One is U matrix, sigma matrix, and V transpose matrix. And as you can see, that these three matrices are very different from the original data. And the middle one is the diagonal matrix. So, and in this diagonal matrix, if you see the color bar here, yellow represents very large numbers, and dark blue represents 0. And most of this matrix is 0 because it's a diagonal matrix. And on the diagonal of it is the singular values, basically weights. And the largest one is on the top here, depicted by this yellow color. And U matrix is nothing but it is the left singular vector, and Vt is the right singular vector. So essentially, when I multiply this with this, I'm going to generate my principal components. And this matrix is going to give me the coefficients or loadings of those principal components or singular vectors. More important part is once I have multiplied these three together, I come back to my original matrix, look at the colors and the shape of this matrix, and look at the first one that we started out from. They both are just the same, indicating that singular value decomposition actually works. And now since we have got these three matrices with us, we can now play around with them. So as I mentioned earlier, I'm going to now use a pre-built function in scikit library called PCA just to keep us on track. And I'm going to generate, using this library, I'm going to fit my data, then I'm going to generate principal components, basically singular vectors. And then I will try to find out how much of variance these principal components have captured. And then I'm also going to, calculate the coefficients and loadings. Let me just, before we forget. So essentially these are the principal components or single vectors. And what you see here, these coefficients are the singular values. This is what we're trying to do. And so let me just run this. And in this part, I'm doing everything manually through singular value decomposition. So I have multiplied my U matrix with sigma matrix, and that's going to give me my principal components or the singular vectors. And my loadings or the coefficients are going to come from my V transpose matrix. And I'm going to then calculate how much of variance each principal component has been able to capture from the data. And the larger it is, the more dominant that principal component is. So firstly, let me run this code and show to you what's happening. Okay, so what has happened is that since we have 30 companies, we will have 30 principal components. So on the x-axis, we have principal components, and on the y-axis, it is telling us how much of the variance each component has been able to capture from the data, from the stock market data. And they have been, so this is the first principal component, and it has been able to capture almost 68% of variance in the data set. And that's why it is the most dominant one. It is shown here. Then the next component is this one, which has been able to capture 12.8 or almost 13% variance in the data set. And the third one has been able to capture 7.8, and so on and so forth. And as you can see, a lot of principal components are insignificant because they are capturing very low variance. Mostly they are capturing noise in the data. They're not able to identify any tangible patterns. So this is what is shown by this tail. This is very close to 0. So beyond, say, 3 or 4 principal components, we can actually ignore all these components because they're not contributing much. They're not giving us any valuable information about the data set. So let's concentrate on these first 2 or 3 principal components. So this is the logic through which we identify out of those 30 equations of principal components, which one of them are dominant ones. So principal component 1, 2, 3 as seen here, because they are explaining the variance in the set beautifully, which means they have identified some patterns inside the data, and they are trying to capture that variance, and hence these equations, these 3, 4 principal components are very important. So sometimes, as I mentioned earlier, these principal components, they get flipped in sign. Basically, they rotate 180 degree. You remember from my eigenvalue decomposition tutorial, I told you then that these are the hidden axes, and these vectors, they don't rotate because of transformations, but they can flip their sign. So there is a sign correct logic here. And let's see how these 3 principal components look. So I'm plotting, so this is my principal component 1. And I'm taking data from, for my first principle, that is single value decomposition, and I'm also taking it from the built-in library of Python that I used earlier. And I'm overlapping both these principal component 1 from both these approaches. And as you can see, they are overlapping, which means the way we are doing things manually, through singular value decomposition, it is matching with a pre-built library of Python. So we are on the right track. And more so, if you see, broadly speaking, this shape of principal component 1 is actually tracking the shape of Sensex. Here. They're quite close, which means this principal component has been able to identify this pattern inside the data. So that's very good thing to happen. And then there's principal component 2, which is also overlapping with the built-in library of Python. And this has a very different pattern. So after capturing almost 68% variation, principal component 1 has been able to identify the broad market trend, which is what is given by the Sensex also. And then the remaining 12% has been captured by, the remaining almost 13% has been captured by principal component 2, and then about 8% by principal component 3. And when we see these are not following, individually they are not following the Sensex pattern, but they can then be following sector specific or industry specific or company specific trends. This is principal component 3. And what in fact we can do is that, let me run this code. So what I've done here is I've taken my principal component 1 from both my manual calculation, from the first principles and from the Python library. So one is in orange, one is in green, and both of them are overlapping, so we are on the right track. And I have overlaid it on the Sensex data. And as you can see, this blue line, which is representing Sensex, is being very closely tracked by my principal component. Remember, as part of my analysis, my Sensex information has not been processed through principal component analysis. It has just been taken, it was popped out of the data set, and it is being plotted separately. And PCA is being done by PCA is being done on the rest 30 company stocks that we are talking about. And once we analyze those stocks, we find a hidden pattern, and that hidden pattern is actually matching very closely with the Sensex, which is the market trend. So you can see the power of principal component analysis here. What I do is that since principal component 1 captures only 68% variation, I also add to it principal component 2 so that 80%, almost 80% variation in the data set is captured, if you remember. So first principal component has explained 68% and next is almost 13%. So if I combine them together, I'll be above 80%, and I would be able to approximate this data set more, in a more accurate form than just using one principal component. That's the idea behind it. So here I am. So this was just one principal component. Now I have added the second principal component, and now you see that this line, this green and orange line, is tracking my market data more accurately. The more we add principal components in this data, the more is the accuracy of the market trend tracking. But as we realize that out of 30 principal components, almost 25 of them are like these ones are contributing nothing. In fact, they are just capturing the noise. And so we need not go in details of all the 30 components, and that's where the data compression or dimensionality reduction comes from. These 3 or 4 are sufficient for us to capture the main trends and sector specific trends, etc. Okay, so now we are here. So just to get back, so out of these 30 equations, we have been able to figure out that PC1, PC2, PC3 are the most dominant ones. And now in these, we are trying to identify the loadings, these coefficients, which of them have the large value and what's the sign of it. So let's start with PC1. So in this plot, I have, firstly, I'm just taking everything from my manual calculation, not from the scikit library. But there are 2 plots here. So one is the plot of PC1, principal component 1, and the second one is principal component 2. The blue one is from principal component 1, and this is the most dominant principal component, capturing almost 68% of variance in the data set. And how to go about interpreting is this. These are the coefficients. These are the strengths of the coefficients. These are some of them are moving in positive direction, some in negative direction. So I have arranged them in descending order, and as you can see, this coefficient attached to NTPC is having very high weight. And then with Tata Motor also, it's having a very high weight. And then something happens here. Just concentrate on this blue bars only as of now. Just forget about the orange ones because they come from principal component 2. You see there are some stocks, for example, Kotak Bank, Hindustan Lever, Asian Paints, and HDFC Bank, which are moving in opposite direction, which means if the Sensex increases, the contribution given by these stocks is much higher and in the positive direction. And these stocks, they move in opposite direction. So in case if the Sensex is crashing, these stocks are negatively correlated and they will act as hedge. So this is as far as portfolio manager can then choose what he wishes to do through these principal component analysis. One is that if he is looking for very high returns in the Sensex basket, or if the portfolio manager just needs to beat the index, that is Sensex, then he can concentrate a lot of money here in these 4-5 stocks which are having very large coefficients here, and he'll be able to capture, because this is capturing this PC1 component is capturing huge amount of variance, which means huge amount of volatility in the stock market, and this is moving in the positive direction. That is, it is correlated with Sensex. It is the Sensex increases, and then the price of these stocks also are contributing in that increase significantly. So if you are just trying to beat the index, or if you are risk seeking, you can invest your money here. NTPC, Tata Motors, Adani Ports, Sun Pharma, Power Grid, etc. They are going to give some very high returns, though at the most optimal risk. If you're having a negative outcome of the market, you are expecting that in near future market might crash or the Sensex may go down, then you can use these blue funds here, which is Kotak, Hindustan, Liver, Asian Paints, as a hedging strategy. So that's the insight that you get from principal component analysis. Now let's talk about this principal component 2. This principal component 2 explains only 12% of the variance of the data set, but it is still very important. We saw that principal component was following the Sensex, which is the main market trend. Here. This is principal component 1 and blue was Sensex. So principal component 1 was able to capture the main market trend, but principal component 2 and 3 are capturing some other variations or some other patterns in the data set. Now these can be specific to the industry. This can be very specific to that particular company. So we have to do similar kind of analysis there. So now concentrate on this blue or this orange, these orange bars. And again, some of them are moving in positive direction, some of them are moving in negative direction. So they can again be used for hedging. Some of them are trying to balance out, the PC2 component is moving in opposition with PC1 component. So you can do invest in these stocks for rebalancing purpose. Okay, so let's see if our PCA is matching with the real world results. So let's switch over to TradingView online site. Here you can see that I have to select a date range, which I have chosen from 3rd of April 2023, which is the start of trading day. And it is going up to 18th of July. So my time frame is correct. And then what I've done is that I have taken the Sensex plot here. And as you can see, this Sensex plot is matching very much with what we had plotted here. So let's see whether our PCA is working in real life scenario or not. So what it says is that let's concentrate on the blue components first because they are very important. So the blue component, it says that Kotak Bank is negatively correlated with the Sensex and it can be used as a hedge. So let's see where the Kotak Bank is. Here it is. So let me just activate its plot. And there you are. Sensex is moving in one direction and Kotak Bank is moving in the opposite direction, which is what our principal component analysis has also indicated. So this proves that our theory is working. The next part is that it also says that Hindustan Liver is also negatively correlated. So let me just see, Hindustan Liver is here. And there you are. For the period under consideration, Hindustan Liver is also not moving in tandem with Sensex. So there also the PCA has given us good insight. Let's see, the next is Asian Paints. So Asian Paints is here. And yep, Sensex is going up and Asian Paint is going in the other direction. So certainly this has practical value. And HDFC Bank, now let's see. So here we are. And HDFC Bank is also exhibiting a similar kind of trend. Let's go on the positive side. Let me just hide it first. So on the positive side, that means stocks that are contributing heavily into Sensex. I think Tata Motors and NTPC and Adani Motors are going to be the rock stars. So let's have a look. Let's start with Tata Motors. And as you can see, this is Sensex and that's Tata Motors. So amazing positive correlation, almost 100% returns. Then let's see NTPC. NTPC is here. Again, 100% growth. It is moving in positive direction. So the Sensex increases and NTPC increases drastically. So NTPC is contributing very heavily to the growth of Sensex. What about Sun Pharma? So here I have Sun Pharma. That's also positively correlated. So you get the idea now. This analysis, principal component analysis works pretty fine. The theory is actually representing what is happening in the stock market. Though this is not the only analysis, and this is just the beginning. There are multiple things that you can do with it, and you can. Most of the professional portfolio managers They are using these kind of techniques to hedge their risks, to optimize their portfolios, to rebalance their portfolios. And behind the scenes, principal component analysis and singular value decomposition is at work. Thank you so much.